Good morning, everyone. Thank you for joining us. I am Amanda DePalma, Vice President of Special Events for the Business Council of Westchester. Thank you for joining today's featured webinar, The Art of Creating Powerful Business Relationships, the importance of connecting with your banker, accountant, insurance specialist, and attorney, presented by M&T Bank. Headquartered in Buffalo, New York, and organized around 19 community bank regions led by local regional presidents. This means decisions about loans and community activities are made locally by the people in the bank who know the community best. M&T Bank has also been a longtime BCW member. We have 4 wonderful panelists with us today. Thank you all for joining us. Vivian Morales, our Vice President and Senior Relationships Manager from M&T Bank. As an experienced senior relationship manager, she was dedicated to deliver courteous professional service to all her clients. She prides herself on her strong organizational skills, attention to detail, and expedited handling of requests from COIs and clients. She is an affiliate member of the BCW and routinely participates on behalf of M&T Bank throughout the New York metro region. Vivian, thank you for joining us today. We also have Daniel Thomas, partner at Vandewater LLP. Dan, a partner, specializes in commercial real estate law, real estate finance, secured transactions, and general business law. Dan, you're a busy man. The majority of his practice involves the representation of commercial lending institutions in real estate acquisition, refinancing and construction loans, CRA lending, and USA Small Business Association Section 7A and 504 loans. Dan, thank you for joining. Matthew McAllister, Business Development, Statewide Abstract Corps. After a stint in financial services, Matt found his real estate career path with Statewide Abstract, a family-owned and operated insurance firm headquartered in White Plains. After 6 years helping thousands of transactions, Matt moved his focus from operations statewide influence in the region. Matt, happy to see you. Stephen Edwards, CPA and accountant. Stephen, with more than 30 years of experience in accounting, taxes, and financial management services, offers outsourced accounting, bookkeeping, and tax services to professionals, small businesses, real estate, and not-for-profit groups throughout the tri-state area. Thank you all for being here, and we look forward to all of the information that you have to share with us.
Good morning, everyone. Stephen Edwards. Thank you for the introduction. Welcome everybody who's on the webinar this morning. We just want to go over basically 4 bullet points as it pertains to the art of creating powerful business relationships. I want to talk about it from an accountant's perspective, and it's going to branch off into the other speakers that will be coming after me. The areas that I want to cover is the understanding your decision and impact of borrowing, questions to address in your loan application, your loan package, cash flow management, and reporting requirements. To go back up to the understanding your decision, it really is a lot easier, a lot more fluent than you would think. As you have an accountant, be a tax accountant or somebody who is handling the monthly closing or the management of your financials, you're going to have discussions around the plan. What's your budget look like? So in the beginning of the year, the beginning of the quarter, whenever you start your business, you want to talk about what is my plan? What kind of revenue do I expect to generate for the year? And then as you departmentize that into months or quarters, it becomes a discussion. Do I have enough money to maintain and support my operations? And as you get down to those kind of questions, the conversation changes, at least in my particular world. We don't have enough money to cover the operation. We don't have enough staff to cover the operation and support the operations. Therefore, it changes to what do we need to do in order to go out and secure those kind of fundings, i.e., do we have to go to a bank? Do we have to go to a hard money lender? Whatever the case may be. But nevertheless, okay, the discussion starts with your budget. So hopefully everybody that's on the call can appreciate the fact that that plan at the beginning of the year becomes a really critical piece as a starting point. Secondly, okay, you want to tie your decision to go out and seek funding to a money-making activity. Okay, you want to either grow your business, you want to maintain a certain amount of revenue, you want to expand your business, you want to change your business. So whatever the case may be, okay, you want to tie your decision to go out and seek funding to a revenue generating opportunity. And you'll see why that's important in the next bullet. Third, you want to recognize the fact that anytime you go out and seek borrowing or seek funding, it's going to cost you more. Why? Because at least the interest portion of whatever borrowing you're seeking is going to have to be repaid in addition to the principal. So therefore, it's going to cost you more money to actually maintain and run your operation. Last but not least in that particular item is that you want to prepare an analysis. The analysis should be something like, we want to borrow money to affect a certain change within the organization. And what is the dollar figure associated with that? Secondly, how are we going to use that money to affect that change? Thirdly, okay, how are we going to repay that loan back to the lending source? When you start asking those kind of questions, it kind of crystallizes the use of the money, how the money is going to be used, what time frame the money is going to be used in, and also how you're going to repay that loan back to it, and what's your expected outcome. Are you expecting to grow your revenue stream? Are you expecting to maybe buy a new building, a new facility, increase your operations? It becomes more crystallized in terms of what your plan is going to be. So again, everything comes back to the plan. What's the purpose of the borrower as it pertains to your plan? So now once you get those kind of questions answered, then you go down to what do I need to put in my loan package? Well, you just got finished answering the question, well, what is your plan? That becomes a critical piece for your package. What kind of funding you need, and for the purpose of the funding, and when you need the funding, that becomes a critical piece for the questions to be included and answered in your loan package. So as you start to answer the questions from the first bullet, you sort of get the ingredients to go into the second bullet, which is the questions to address what goes into my loan package. Because the lender is going to want to see, one, how much money do you need? Can you support it? Is your credit worthiness sufficient to support the loan? And do you have the ability to be able to pay that money back within a reasonable period of time? So those are the kind of questions that the lender is going to want to see and want to be able to answer to themselves before they advance you any types of funds. As you get the funds, now it becomes a thing of managing those funds to be able to, one, use it for the intended purpose, and also to make sure that you have the ability to repay the funds back, i.e. cash flow management. So once you get the funds, now it's a matter of managing those funds so that you're able to one, manage it so you can spend it for what you intended to spend it for, but also to repay it. So therefore, in my world, we work with the clients to establish what they call a cash flow budget, where you look at the inflows and the outflows of your cash flow from the revenue as well as from the loan to determine how you're going to manage those funds. And after all that is said and done for, the bank may still have requirements for you to adhere to, which is the reporting requirements. The bankers are going to want to know that from time to time that you're able to, again, continue to commit yourself to repaying the loan. So in some cases, the bank may ask you to submit monthly, quarterly, or even annual financial statements, most of the time annual financial statements, to them that says, one, here are your assets and here's your profit and loss. So you're going to have to work with your accountant, your CPA, in order to establish these different types of platforms, one, to be able to analyze the loan, to be able to manage the loan, and also to report the loan at some point in time. So when you look at the different relationships that you want to maintain or you want to establish, one should be your accountant. And if your accountant is working close enough with you, a lot of these questions should be a part of your monthly or your quarterly discussions in terms of your finances. That's it for me. Any questions? We save it for the end. Next up.
Good morning. This is Vivian Morales. I would like to share best practices, right, as a banker, based on the years of knowledge and experience, the understanding of the purpose and the cause, and how we work together as bankers with all our partners, especially with the CPA. I always call it the understanding the purpose and the cause, the dating part of, because you need to understand the need of that capital. Why are they expanding? Why are they requesting money? Sometimes we get, potential clients or prospects that are looking for something, and then by probing and asking the questions and understanding the purpose and the cost, we could structure things differently, right? And it's all based on need and understanding that need. And again, the background, right? The background is important because we need to understand the company, the entity, or the entities that are involved, the principals, partners, the borrower, the structure. There's a lot that goes behind the story, and putting together a story to be able to then translate that and help, our senior credit officers feel, touch, and understand, because they're not there physically. We as bankers, we are, right? So we are the voice. We're the ones that have to understand the background and the individuals to be able to then advocate and translate that information. And then the financial piece, understanding those requirements. Sometimes we go back and forth with the CPA or the guarantors, the principals, because there's certain information that is required for us to really understand how the company, how the individuals are going to be able to pay us back, right? And understanding what's going in and what's going out, right? Those one-time events, anything that is going to be value and helpful to us to show the ability to pay. So that's why I truly believe that's important that you have a CPA, an attorney, a banker, your insurance guy, a group of professionals that could actually be there for you to help you navigate through the process, because it's not easy, right? But it's our job to make that transition easy. So that's why we thought it's perfect to kind of demonstrate how we, the panelists, we could provide a lot of value when there's a need for capital for any type of finance. And then, of course, there's the collateral piece. There is, understanding how we're going to get the collateral and the personal guarantee, the liquidity. There's fees involved, right? So it's understanding the full story, the whole need of that capital that's in place, and how we together as a team, we're going to be able to translate that and put a story that we can demonstrate the purpose, the cost, and the need of that loan and how we're going to get paid, right? And then there's the full package. Sometimes as a banker throughout the years, I've had, pieces, and I call it the puzzle, right? And you get an email today, you get an email tomorrow, and you're trying to put together a story, but you're getting pieces day by day, and sometimes it's hard. From the time we get a full package, and when I mean a full package is when we require and we tell you, we give you our pre-screen checklist, right? We need the last 3 years of your business tax returns for the business that's going to be acquired, or just the business, the borrower, the last 3 years on the personal side, current year interim statements, a balance sheet, a P&L, just all the information that's going to allow us to come up with that cash flow, how you're going to repay us back, right? And so that helps us then put together the full package to translate that information to senior management and demonstrate the strengths and the weaknesses and how we're going to mitigate certain things. And then, at that point, when we have a full package, a full understanding of the structure of the loan, and let's not forget, the 5 C's in credit, but now we call it the 6 C's, right? With COVID, understanding the the capacity, the capital, the condition, the collateral, the character, everything. Once I have that entire understanding, then of course, then that's when I can go to my team leader, to my regional, and demonstrate why we want to do this loan, and submit the loan. So that's my end as a senior relationship manager. Next up is Matt.
All right, thank you. So now that you've done the due diligence with Vivian and identified the ability or the desire to move forward with Steve and how that'll impact your business, if you are going to be borrowing money for either refinance or construction loan, or you're going to be purchasing property, anytime it's backed by real property, title insurance is triggered. So I'll start off with what is title insurance. A lot of people know they've ordered it or paid for it, but not sure exactly what it does. So title insurance is not insuring against future risk, but what we're doing is looking backwards in time to review the chain of title. So we go from deed to deed and look at the transfer of ownership. And we also look at the intervening mortgages and or judgments and liens that were put against the property, so that at the time of your purchase or refinance construction loan, you know that you are buying the property from the rightful owner, free and clear of any judgments and liens. So in order to do that, we run various searches, all with differing timelines and searches which we have differing controls over. So the deed search that I mentioned, that all takes place in the county land records. That is something done by us. It can be simple, but you don't know when you start what you're going to get into. So it's kind of a little bit of detective work, and you just keep pulling the thread until you find it. So if there is, you sometimes wind up in surrogate's court if there's different deaths or chasing down open judgments from prior owners. So there's an unknown sort of timeline there. We do searches in the building department. So namely looking for the certificate of occupancy for a building. Are there any open permits? If there are, your lender is going to want to see those closed before you close on your loan or your purchase. Those are searches that we order, but we don't necessarily have control over the timeline. There are certain places it can take up to 4 to 6 weeks. They often have part-time workers there, so it's not a speedy process at times. We'll order a survey, again, outside of our timeline. So that surveyor is going out to the property to identify what this property is. So what are the actual meets and bounds, and show that of record. And then, of course, we need your LLC documents. We need to see your operating agreement to see who can sign for this property. If it's an LLC owned by an LLC, well, then we need that LLC's operating agreement. We need to go all the way down until we can find out who is in charge of acting on this, on behalf of this entity. And now I say all this to kind of just highlight the various opportunities for delay, right? So you've made the decision to borrow this money. You've worked with Vivian to get her everything she needs, but then title insurance is ordered. So if you're looking to move to expedite the process, you want to make sure that you're putting your best effort to provide accurate information, right? So to Vivian, what is the property that you're looking to affect? Who are the entities involved with the transaction? Is there a buyer? Is there a seller? so that we can get our searches started and done correctly the first time around. And a big part of that process, my conversation is with the attorney. So you don't often interact with the title company directly as the consumer. It's something that would be generally ordered by your attorney. And I find that the process works best when you have open lines of communication with these business partners. So when I can speak to Vivian directly and get these LLC documents provided to me quickly, or the attorney, Dan, who will be speaking next, can call me and ask, what does he need to get from his clients in order to clear up these title issues so that we can close the loan? And that's kind of the main point of our presentation here is showing that the connection of these business professionals is to your benefit, because it speeds up the process. It makes just everything more efficient so that you can get from the decision to make this business move to actually implementing it much faster and more painless. So to speak a bit more on that process is one of the integral cogs in the plan is your attorney. So up next is Dan Thomas.
Great. Thank you, Matt, and hello, everybody. So the purpose of my portion of the talk, is to discuss common commercial pitfalls in lending transactions and steps you can take to avoid them. With interest rates starting to tick up from historical lows, borrowers are very eager, obviously, to close on loans as quickly as possible. Many find themselves facing slightly longer lag or lead times than expected, and quite often that's because of a misunderstanding as to what types of documentation has to be provided, or just improper planning. So the point of my portion of this is to highlight, I guess, 4 main areas. One would be preparation, disclosures. The third are longer lead time items we run into often, which Matt has touched on a little bit, and then a little bit about SBA lending, which there's obviously a lot of that going on right now. So to get to the prep piece, first and foremost, the key is to being, you got to be prepared for the myriad information that's going to be asked of you, both of the lender, which Vivian has touched on, and of lender's attorney, because obviously there may be some overlap, but differentiation in terms of documents that need to be reviewed. So I would, suggest ask up front for a closing checklist. The bank may not have one specific for your deal at this point in the process, but certainly their counsel should be able to provide you with, a general list of items based on past experience or past deals that give you a good sense as to what's going to be required to start cobbling that stuff together. Obviously, that's going to speed things up for you when you get past loan approval and into actual documentation. It's also going to focus your mind a bit on what, again, the plan that Stephen has talked about a bit, like what it is that we're doing and what needs to be delivered. And we'll give all the other parties involved things to do while the bank's third-party reports, their appraisal, environmental, and flood and whatnot is all being worked on. So I certainly suggest getting the closing checklist up front. That'll help speed things along for you. Common requests in the prep stage include, we talked about financials, both Stephen and Vivian have touched base on that. It's tax returns, it's potentially personal financial statements, it's the financials for any corporate holding companies or operating companies involved in the deal. There's certainly some documentation there that the bank would need very early in the process, as Vivian has stated. Matt touched on a bit the organizational documents. If it's an LLC, we need operating agreements and articles of organization. We need to understand who the members are, who has the ability to sign for the deal, who has control of the entity. This is also true of corporations, where you need to see a certificate of corporation and bylaws. If you've got real property held in a trust, the bank and the bank's attorney are certainly going to need to see that trust agreement to understand, the scope of what can be done with the property, again, who has authority to sign for the property, that sort of thing. Remember that for all corporate entities, you need duly adopted resolutions authorizing the transaction. Usually, or quite often, the lender attorney will provide a form of that, but it's something to keep in mind if you have a very complex structure that's going to require numerous approvals from various directors or shareholders or whatnot. You're going to want to cobble these, get these people together and either have a meeting or do it via unanimous written consent. So that's all prepped and ready to go come closing time. Another big one is, if you've got property that's investment real estate with leases in place, you're certainly going to need to provide leases and rent roll to the bank. But you may also be asked to provide estoppel certificates for commercial tenants and potentially subordination, non-disturbance, and attornment agreements, which is particularly true with commercial tenants where their leases don't provide for auto subordination to present and future mortgages. So that's another thing where you've now got to involve a third party, the tenant, in signing some documents for the bank. So again, you're going to want to ask if that's a requirement early on, get the forms early on, and then you can touch base with your tenants to get those signed. Matt also mentioned surveys. Find out early on if a survey is required. If it is, what the parameters are. So in some instances, the bank may take just a simple boundary survey. In other more complicated projects, they may need a full-on ALTA survey with a list of Table A requirements. All these are questions that can be asked up front so that you can start putting together your surveyor and getting them going. It's probably too early at that point in the process to actually order the survey, but at least then you've got an understanding of what's going to be required. I would note too that it's a fairly hot market right now. So surveyors are booked out longer than maybe typically. So you're going to want to touch base with them, get somebody teed up and ready to go once you've got the loan approval and you're ready to rock. So certainly check with the bank early on as to what their potential survey requirements are. Getting to my second point now, disclose. So if there's potential issues with the loan, whether it's your credit, whether it's the property itself, the nature of the transaction, any pending litigation against you or any of the entities involved in the transaction, all of that are things you're going to want to flag for the bank really early on. Because the last thing you want to find out is you get a month and a half into this process and you've got that pending litigation that you're convinced is meritless, but now the bank has questions, the bank attorney has issues with it, we've got a potential closing problem. All stuff, if you disclose up front, a path forward can be kind of laid out to get going. So common issues in the disclosure realm would be, source of funds. If you've got, quite often a lot of loans require an equity injection, whether it's a purchase or sometimes different kinds of various structures. If you're getting funds from friends, as a gift or family, you want to tell the bank that as soon as possible, because obviously there's going to be some documentation requirements on that front to establish where the money came from. That is in fact a gift and is not expected to be paid back, those sort of things. We'll touch base a little bit on that when we get to the SBA piece. I mentioned pending litigation. If you've got something against your entity or your holding company or you individually, the bank may ask to see an opinion from the counsel handling that matter to get a better sense of the nature of the action, current status, litigation counsel's opinion as to the likelihood of the plaintiff's success on the merits, and then where possible, an estimate of the likely losses. So as to estimate for the bank what the potential adverse effects the borrower might be. I'm also seeing, oddly enough, these days, a number of Article 15 or quiet title actions. This is where someone is bringing an action or has brought an action against property, claiming an interest in that property, who's not the person who's mortgaging the property in this scenario. That's obviously a potentially large issue that needs to be addressed early. And I've seen instances where parties didn't get to it till late in the game, which pushes down past closing quite a bit, because obviously you've got to have that resolved before the bank's willing to put a mortgage on that property. If you're in a purchase transaction and your contract has a time of the essence provision, that's where they have a hard date as to closing. Again, that's something you're going to want to flag for the bank. You're going to want to flag for the attorney, flag for title, get everybody plugged in up front about that, because that's a target date that everyone has to work around. Similarly, with a 1031 like-kind exchange, if you're on the replacement property stage of a 1031, or you've got a seller doing a reverse 1031, those are hard dates set by the IRS, that outside closing date. So that's not something that can be moved. You've got to flag that early on for people so you don't run into a last minute issue where we're missing this potential date. Now the tax implications are kicking in and you've got a substantive problem. So skipping now to my third item, some of the longer lead time items, as Matt mentioned, and we covered many of these already, stole my thunder, Matt. So, some of these items are outside of the scope of what we can necessarily do for you, but we can certainly help to guide you and get the proper people plugged in so that these kind of balls can get moving sooner rather than later. Matt mentioned a really big one, which is municipal searches. As he noted, some of those entities, some of those municipalities are pretty far behind in providing CO searches. Some of them are short-staffed. Some of them require inspections or affidavits or certain fees paid up front in order to get those things. I've seen them take 4 to 6 weeks in some scenarios. So you certainly want to find out early on. If it's an acquisition, you can assume municipals are required. If it's a refi, they might not be, but ask, find out early on if it's something you're going to need, and then we can get Matt involved and get him going on that early. Survey is another one Matt touched on as well. Again, it's a really hot market, so we're seeing longer lead times on some of these things. You're going to want to tee that up as soon as you can. I've been seeing as of late, as a third item here, open tax warrants on properties that people are buying, where the tax warrant is filed against the seller but attaches to the property being purchased. That's something that's, again, a potentially big title issue. It needs to be addressed, either paid with the IRS, settled, negotiated, somehow resolved, and that tax warrant released before you're going to get to sit down at a closing table. So that's another one that if we find that early on, which will be usually flagged by title, but sometimes buyers know this in advance, you're going to want to get all the parties involved on that so they can tackle it pretty soon. Another very common one, especially right now with the changes in rates, are assignments of mortgages. So for those of you who don't know, borrowers, when you borrow money that's going to be secured against real property, by mortgage against real property, you get to pay mortgage recording tax on the quote unquote privilege of recording that mortgage in the state of New York. There is a method by which you can save some of that mortgage recording tax, and that is where the new lender were to take an existing loan by assignment, and you would only pay the mortgage recording tax on the difference between the new amount and the outstanding principal of the old amount. That's all well and good, and given the depending on the amounts and the assignment fees and whatnot that are charged, could save you a significant amount of money on a deal. But you got to bear in mind that that takes a sizable amount of time. Existing lenders got to pull its original collateral file with the original notes and mortgages and whatnot. They've got to deliver that to either Matt, title company, or myself as bank attorney to hold an escrow. If the existing lenders counsel has to draft a number of assignment documents to prep all that and put all that in place. So all of that, again, those things can take between 2 and 4 weeks if not properly flagged in advance. So if the plan is to have your new lender take an existing mortgage by assignment, you certainly want to jump on that as soon as possible, so you're not waiting for that piece when everything else is done. So last but not least, just touching briefly on SBA lending. There's obviously been a lot of that going on with the SBA guarantee was waived for quite some time, the guarantee fee rather. So one of the big ticket items, if you've got a loan that's going to be secured by business assets other than realty, so non-realty, fixtures, furniture, personal assets, those kinds of things. The SBA 7A will typically require a landlord subordination waiver on those assets. It has to be signed by your landlord. Landlords like to negotiate these things. They don't typically like the standard forms. That takes a considerable amount of time. I've seen that run a couple of weeks. So that's another one early on. Get your lease over to the bank, get the landlord, request the landlord waiver form, get all that stuff over to the landlord so that process can start while everyone else is doing their work in the background. Another common piece of kind of ancillary collateral on SBA deals, particularly 7As, is an assignment of life insurance, whereby the owner of that policy signs the death benefits and some other rights over to a bank as additional collateral security for the loan. It's a multi-stage process. It requires both applying for life insurance if you haven't yet done that, which would usually entail a health screening. You've got to actually sign assignment documents over collaterally assigning that, and then the life insurance company has to consent and acknowledge to that collateral assignment of life insurance. Again, you've got lead time issues with this. That's one we see all the time, which slows down closings, which otherwise would have been ready, and now we're scrambling to get this part done. So that's early on, ask if it's part of the deal, get the documents from the bank, contact your life insurance company, get that stuff going as soon as you possibly can. Last kind of big item on my SBAs, I did mention up at the top, was equity injections. With many SBA deals, the SBA often requires that there's a certain amount of borrower funds put into the deal. There's a bunch of different ways you can establish that, all of which has to be properly documented, and the SBA is fairly specific about what they want to see. So for instance, if you've got gift funds, which I mentioned at the top, you're going to need to get gift letters from the people giving you the funds, bank statements for the past 60 days showing where those funds came from, that they weren't borrowed from somewhere else or some other entity, canceled checks, and then statements going into your business account to show that the funds are now there and ready for use. Similarly, if you're establishing your equity by virtue of paying business expenses, you got to provide invoices, you've got to provide the canceled checks, the past statements, all of this so that the story Vivian mentioned can be kind of put together, and we can establish and show to the SBA, okay, here's how much money was has come in from the borrower's equity side of things. Here's how we show it's actually equity, not something else, and here's how now it's ready to be used on the loan or on the deal itself. One really quick note about that. Bear in mind, and we do see this regularly, that the payment of business expenses via credit card or line of credit is not an equity contribution. That's an incurrence of additional debt. We have seen a number of instances where people think, oh, I'm putting all this on my credit card, it counts as business expense. It does for their purposes, but it does not for purposes of establishing that they've actually put their own funds into the deal. So that's another one that, again, can slow you down if you're not ready. None of this stuff is particularly heavy lift. It's really just a matter of kind of being organized, getting your stuff together, finding out what you need if you're not sure, and asking questions of the people you're working with, the partners who are part of the deal, so that there's no surprises at the end, and everyone knows the information that they need to provide and is ready to provide it. So in short, on my end, it really is about prepping, disclosing, and being prepared for those longer lead time items. Ask for that checklist. Ask about parameters you may not be aware of in terms of what might be required. Get your parties and your players involved as soon as you possibly can, so that it runs nice and smoothly, and we're in a closing in a month, not 7 months or something like that. So that is the crux of what I have. I think we are off to the question section.
Yes, thank you all for that question from the group. What are the minimum loan requirements for new LLCs that have no historical information?
So I'll answer that. There are no boxes how we look at deals. It sounds more like an SBA opportunity. So I would say for the individual to please reach out to me to further discuss, all the details and specifically the requests. SBA, as we know, was created in 1953, and it's an independent agency for the federal agency of the federal government, and the purpose is to aid and counsel and assist individuals, right? And so there are different ways, and it depends on the deal, right? Depends if it's a startup, it's an expansion, a business acquisition with partner, a buyout. There's commercial real estate involved. So, case by case differently. And if there's no historical numbers, we work around projections, right? And for the most part, we require 2 years of month-to-month projections with supporting assumptions. So I can go on and on and on about it, but I would love, to have the conversation with the individual to further discuss.
Absolutely. Vivian, thank you so much. Stephen, Daniel, Matt, thank you all for joining us. We're going to go ahead. This presentation is posted on the Business Council's website. We are also on our Facebook page, so folks can reach out with further questions. Vivian, the person that had asked the question, said thank you and that they will reach out to you. So appreciate it.
Thank you.
But again, thank you all for joining us. Enjoy the rest of your summer, and we'll see you really back with our featured webinars in September.
Thank you.
Thank you all again.